Now, the banking and wealth management group Investec says its recovery is continuing, with half-year profits more than doubling from the same period last year. But increased client activity and lower funding costs help boost profits at the group. It's also announced it's going to distribute a 15% stake in the asset manager 91, which it spun off earlier this year, to its shareholders. Well, Investec's Chief Executive Fani Titi joins me now live from Johannesburg. Fani, very good morning to you. You've seen a huge improvement, in particular, in your UK business. What's driven that?
Good morning, Ian. It's been a fantastic set of results to present this morning. We saw client acquisition increase. We saw, in particular in our private banking space, significant traction in terms of an increase in underlying loan growth. We also saw the same in our corporate banking business, and our wealth business also did particularly well. So it's been a good period to report, particularly post-COVID, where we had seen a reduction in activity at one point and losses in our structured finance hedging book. Those losses interrupted our growth momentum. They are now out of this reporting cycle. So we are pleased with the increase in profitability.
Now, your funds under management in wealth and investment rose by nearly 9%. How much of that was down to inflows and how much of it was down to investment performance?
Look, we obviously benefited from increased markets. So the overall increase in terms of net inflows was around 650 or so million pounds. And largely, as I say, the increase in stock levels, second, investment performance, and thirdly, net inflows.
What are the differences in the recoveries that you're seeing in the UK and in South Africa? Are they significant?
Yeah, very much so. The UK has seen a significant level of vaccination in the nation. In South Africa, we are still at about a third of the population vaccinated, and probably only in March, April next year will we see approximately 70% or so of the population vaccinated. The economy has been growing in South Africa on average at about 1% or so, because we haven't seen the structural reforms that are necessary to unlock growth. So there are significant bottlenecks in South Africa, although our business continues to perform well in the private banking space, the wealth space, and in the corporate space. Because of the lack of confidence that is in the economy, we have seen more redemptions and repayments, so muted loan growth there. Whereas in the UK, both private banking, wealth, and corporate banking has seen significant momentum. I think there is a better sense of what the trajectory of the economy may be in the UK than would be the case in South Africa.
Now, you've an interest rate decision due in South Africa today. Obviously, there's talk of rate rises both here and in South Africa. To what extent is that going to impact on credit demand, do you feel?
Look, we've had a lot of liquidity. We have had a lot of cheap money, and we've had a lot of stimulus, both from treasuries on the one hand and from central banks. It is now about time, I think, that some of that liquidity is drained out. So we will see, I think, some reduction in demand over time, because the expectations are that inflation is a lot more anchored than it is transitory. And as we see these interest rate hikes come through, they will affect demand. But for banks, we will get to earn a bit more on our endowment. As you know, we keep our capital with the central banks, and at the moment we're earning next to nothing on our excess liquidity, as it were, and on the capital that we place with central banks. So net for financial services groups and banks in particular, we would expect that higher interest rate environment will be more positive. You know that we were worried about negative interest rates. We are now on the other side of that worry, as it were.
Now, the last time we spoke, it was at the height of tensions in South Africa following the jailing of the former president, Jacob Zuma. Have you seen much evidence of disinvestment since then?
It's been difficult to attract investment into the country because investors put money into the country long term. Obviously, we have portfolio flows that come in and out with interest rates going up across the world. Generally, that will signal a level of outflow from emerging markets because the carry trade is not as attractive. So as the country goes forward, I think we have to make a stronger case for investment, and that requires the government to implement a number of structural reforms. As an example, the government needs to fix the load shedding that is currently bedeviling the country. You can't have economic growth if you cannot have stable power supply. There needs to be more investment in water infrastructure. There is an opportunity if the licensing and regulatory regime is more accommodative for the country to invest more in renewable energy, as an example. So some opportunities for growth, but some significant regulatory constraints, I would say.
All right, Fani, we have to leave it there. Very good to talk to you again this morning. Thanks very much indeed for joining me.
Thank you, Ian. Thank you for having me.